A very warm welcome to all of you. Thank you for joining us for today's webinar on Union Budget and its implication for India's growth outlook markets and key sectors. I am Sonal Mittal, Product Specialist at UTI. The Honorable Finance Minister presented her ninth Union Budget yesterday with a clear emphasis on continuity, supporting GDP growth, strengthening capex, and staying the course on fiscal consolidation. Measures such as higher STT on derivatives and taxation of buybacks indicate an intent to curb speculation and reduce tax arbitrage, while policy support for manufacturing, especially in areas like semiconductors and data centers, remains a key focus. Today's session will decode what the budget signals for the road ahead and how investors should interpret these developments. We are delighted to have with us Mr. Pankaj Pathak, Fund Manager Fixed Income, and Mr. Parag Chavan, Head of Equity Research, to share their perspectives. A few quick housekeeping points. All participants will be on mute. Questions can be submitted via the question answers box, and we will address them towards the end. Let me now invite our first speaker, Mr. Pankaj Pathak, to share his insights on the macro and fiscal aspects of the budget. Pankaj, over to you.
Yeah, thank you, Sonal, and thank you everyone for joining us today for this analysis of budget and its impact on markets. So one thing that came out was that this budget is more about continuity than big bang announcements. And we have seen some big bang announcements in the last 2-3 years, from capital gain tax, income tax, and lately the GST reduction. So it made sense to have some settling and cooling of those things. So we have seen that there were a lot of micro interventions announced. Maybe Parag will cover those when he cover about all the sectors. But from fixed income markets perspective, the big headline was about the continuation of fiscal consolidation. Now, this was a kind of a little difficult year in terms of government revenues. Income tax had slowed down because of the earlier income tax cut. There was GST reduction during the year. So there was clear shortfall on the revenue side, and that you can see here compared to the budget estimates. We had a lower collection on both the income tax and the GST collections. Despite that, government prioritized fiscal consolidation, and they reduced the fiscal deficit or managed to achieve the fiscal deficit target for FY26 in their revised estimate at 4.4. Apart from that, they also continued with the fiscal consolidation at a slightly slower pace now. Now, in following segment, I'll just break down how overall accounts have been done. Now, on the revenue side, especially, if you look at the revenue growth, the gross tax collection are assumed to grow at 8% year-on-year term in FY27, which seems reasonable given the nominal GDP growth is expected around 10%. So that comes to around tax buoyancy of around 0.8. And if you look back over the last 5 years, the average tax buoyancy has been closer to 1.1. So the government has been relatively conservative in terms of putting those numbers on the tax. And it also made sense in light of the GST rate reduction, because that was implemented later half of the year, and much of the impact will be seen in the next year as well. While income tax, we have already seen the impact in FY26, and maybe in year-on-year terms, the 11.7% number looks reasonable for the next year. So all in all, tax collection looks reasonable and achievable. It adds credibility to overall budget estimates. On the non-tax side, over the last few years, we have seen increasing participation from the RBI dividend, and that again continues, where government has budgeted around 3.1 lakh crores of revenues from RBI and PSU banks. So almost around similar level compared to last year. And given RBI has increased their securities holding and there are a lot of FX sales as well, these numbers look achievable, or even RBI can surpass those numbers. While on the disinvestment side, we have seen a pickup this time. So for the last few years, government has kind of put the disinvestment target at a lower level. But again, we have seen some rise there, around 80,000 crores number put for disinvestment compared to 30,000 crores on the revised estimate of FY26. This looks little aggressive in terms of achieving these numbers, given the last few years disinvestment collection. However, there is a space in the RBI dividend, as I said. So last year, RBI kind of put their contingency reserves at a higher level. So as per the economic capital framework, RBI has to maintain contingency reserve between 4.5 to 7.5% of their total assets. And it was at the higher end of that spectrum. So this year, they might not contribute to that, or maybe even reduce a little bit to transfer higher dividend if that need arise. So there is room for higher RBI dividend, which can offset some of the disinvestment shortfall if that occurs. So all in all, I think it's a reasonable assumption across the board on the tax and non-tax, apart from little bit aggressive assumption on the disinvestment front. Next slide, please. Now, apart from the recent numbers, if you look back at the trend, how the composition of their receipts are changing, what we observed is that, one, the contribution of direct taxes in the overall tax mix has been rising for the last few years. And if you see the divergence, it has increased significantly in the last few years, where direct taxes now contributing more than 60% of the total tax mix, while indirect tax share has fallen. With the GST rate reduction in this year, we'll see further decline in the share of indirect taxes in the overall tax mix. Now, there are some significant implications. One, that in some part, the decline in indirect tax was also reflective of the lower consumption in the recent past. However, it also shows a reduction in the recent indirect tax rates. So it's a significant move on the tax segment. Now, apart from tax, we have seen increasing share of RBI dividend in the RBI's overall tax collection. So if you look at their revenue receipts, now the dividend and profits accounts for more than 11% of the total revenue receipt. Major part of that is coming from the RBI, given the increased securities holding and increased FX intervention lately. Next slide, please. Yeah. Now, on the expenditure side, when we look at the revenue expenditures, so over the last few years, government has been keeping a very tight leash on the revenue expenditure, and they remain focused on boosting capital expenditure. And we have seen the similar trend even this year. So the revenue expenditure is budgeted to grow at 6.6% year on year, which is significantly lower the growth in nominal GDP. And that you can see as a percentage of GDP, government's revenue expenditure is expected to come down to 10.5% from 10.8% in the revised estimates. One of the things that they've been capping or putting under greater control has been the subsidies. And we have seen some increase in subsidies in FY26 revised estimate. But again, for FY27, the subsidies overall are expected to decline from 4.7 trillion to now 4.5 trillion for FY27. And as a share of GDP, again, you can see that from 1.3 to 1.2% of GDP in terms of subsidies. While interest payments have been an area where I think the greater focus required, where the share of interest payments has been rising. And even in terms of growth, if you see, it's slightly higher than the growth in nominal GDP. On the capital account, as I said, that governments, this has been the government's focus area, building infrastructure, all the road, railway, sports infra, build up kind of things. And we have seen a higher increase in the capital expenditure of 11.5% year on year. Though in the current year, FY26, in the revised estimate, they reduced the capital expenditure marginally. So as a percent of the GDP, we have seen capital expenditure kind of flattening out around 3.1% of GDP over the last 2 years. Before that, it was rising significantly, and I will show that in the slightly longer trend in the following slides. But if you take into account the PSUs, because there are a lot of government-owned entities who are doing their own capex in different sectors, mostly in a lot of infra sectors. If you account that, the overall capital expenditure, including PSUs, that goes up to around 4.3% of GDP. So again, a reasonably high capital expenditure from the central government. Overall, as I said, they have been keeping their revenue expenditure under tight control. That is also reflected that this budget will be, this is appear more kind of a non-inflationary. We didn't find anything which can fuel inflation in a big way. There is no big cash handout or those kind of spending here. So to that extent, it should be non-inflationary. And next slide, please. Now coming to the expenditure trend, if you see, again, the quality of expenditure has been improving for the last few years, and we have seen that trend continuing even now. And when I say the committed expenditure, that is mainly the salaries, pensions, their interest liabilities, or various subsidies what government has committed. If you look at the share of these kind of expenditure, that has come down from a peak of around 59% in FY22 to closer to 50.5% in FY26, and budgeted to decline below 50% in FY27. While one, again, the thing that we need to watch, and that's showing a little bit of worsening in the committed expenditure side, is the interest payment. Share of interest payment is rising, and that reflects that kind of a wider fiscal deficit and slightly higher debt on the government's book. So the share of interest payment has increased to around 26%, or slightly higher than that in FY27. While the capital expenditure, as I said, they've been boosting capital expenditure for the last few years. If you see from FY20 level, where capital expenditure was around 1.7% of GDP, that increased to near 3.1 in FY26, and pegged at 3.1 at the same level in FY27 as well. So this has been the area where government is willing to put their trust, and numbers shows that. On the other side, if we see the direct assistance through various schemes on through food guarantee or job guarantee or income guarantee. So we have seen all these schemes from Narega to PM Kisan, all the food subsidy budget, and we've recently seen the new employment generation scheme, and the Viksit Bharat G scheme. So all these combined, if we look at their share, it was significantly higher if we remove even the, say, the COVID year, which shows around 3.7. Even in FY22, it was 1.4% of GDP, or FY20, it was 1.4 before COVID. and FY22 1.5. And since then, it has been coming down consistently till FY26. Now, in the revised estimate, we have seen slightly higher allocation on these parts, and FY27 again around 1.1%, but it still looks more manageable on these direct assistance scheme. Government has been reducing their exposure while facilitating employment and job creation on incomes more through building infrastructure and facilitating private participation. So there's one fundamental change which we are seeing on the expenditure side. And again, as these numbers show on the citizen side, it shows that the budget again will be non-inflationary through these expenditure. Well, again, interest is one component we are keeping a close eye. Yeah, next slide, please. So with that, the combination of these two, the revenue and the expenditure, we have seen on the fiscal deficit. Again, government has shown some commitment in reducing their fiscal deficit and their debt as a percentage of GDP. So FY22, I think when they proposed to reduce the fiscal deficit to 4.4 by FY26, or below 4.5 by FY26, and they achieved that through by building 4.4% fiscal deficit in FY26. And again, I'll highlight this was a difficult year to manage the number, given there was a huge shortfall in the tax collection. We have seen the income tax and the GST cut, but it shows the government's commitment in managing the fiscal deficit. And again, for the FY27, they propose a lower fiscal deficit, though the pace of fiscal consolidation has slowed down. So 4.3 is a bit of disappointment from market standpoint, where the expectation was somewhere around 4.2% fiscal deficit. And same way in the last year, the new framework or the strategy on the fiscal side is to manage the debt to GDP, where, so on the graph on the right side, you can see government in FY26 proposed to reduce their debt to GDP to 50% plus minus 1% by FY31. And last year, or in this year, rather, in FY26, the debt to GDP stands at 56.1 for central government. Now, to reach to FY31 50% target, they kind of propose various paths with a degree of fiscal consolidation, whether they will adopt a higher fiscal consolidation pace or lower, and different rates of growth. And you can see what kind of levels they can go to through those assumptions. So this year, broader expectation was that probably government will peg the debt to GDP goal at 55%, while the actual target is set at 55.6%. So again, on the debt side, there is a little bit of disappointment in terms of fiscal consolidation, though it shows the commitment from the government that they will continue to reduce their fiscal deficit and debt. The pace of reduction is somehow slower this time. So, and this will warrant higher fiscal consolidation going forward in coming years if they want to achieve their targeted goal. Yeah, so from that, now coming to the borrowing part, as that impacts the market more directly. Next slide, please. Yeah, so with that, the net borrowing target is set at 11.7 trillion, and accordingly, the gross borrowing number goes to around 17.2 trillion. So again, there was a bit of disappointment here, where the market expectation was of somewhere around 16.5 lakh crores of gross borrowing. And in that comparison, the gross borrowing number in the budget looks significantly higher. So that might put pressure on the bond yield curve, especially at the longer end going forward. While if you look at the overall mix, in the last 2 years, government has reduced their T-bill borrowing. They were net payer of T-bills in FY25, and they kept it at zero in FY26. And now for FY27, they have again pegged to raise money through T-bills to the extent of 1.3 lakh crores. And also the small saving, only marginal uptick in the small saving from 3.8 lakh crore to 3.9 lakh crores in FY27. Apart from that, on the gross borrowing, there is a switch also planned for 2.5 lakh crores. In FY26, they had a similar target, but that was reduced significantly to closer to 1.5 trillion. And again, for FY27, they have pegged these numbers, but our expectation is that probably if we face pressure on the yield curve, they might reduce the overall switch number. So net, the duration supply will persist at a higher level, and that might put pressure on the bond yield curve. And next slide, please. So to summarize all this, I would say one that the continuation of fiscal consolidation is an encouraging sign from a medium-term perspective. It will help build macroeconomic stability. The borrowing numbers, as I said, was higher than expectation, and that is a concern for especially at the longer end of the yield curve. Though on the demand side, if you see, this year was not that good. While on most front, all the major buyers, we see demand actually improving in FY27, as we have seen increasing uptake in insurance collections. Pension fund, their allocation to equities have reached to a significant level where they were allocating more towards equity last year, but now they have reached to certain points very close to the levels where they wanted. So probably next year we will see increasing flows from pension funds. Even for banks, they had reduced their SLR holding, and from next year, I think we'll see some improvement there. Even for the regulatory requirement, and they have to buy more bonds. Apart from that, RBI has been doing OMOs, and most likely they will continue with more OMO buybacks in next year, and that should be supportive or offset some of the impact of this supply pressure. Now with budget behind us, there will be focus on RBI policy, which will be which is due later this week. And our expectation is that probably RBI will keep the rates on hold. Much of the easing is already done. While they will provide more clues on the liquidity and probably do more action on the liquidity through OMOs and FX swaps, what they have been doing. And there could be other announcements as well. So that will be one driving force for the bond market. Now, if you were to put that overall impact on the bond market, I think we have this lower for longer monetary policy setup, and RBI is doing a lot of liquidity infusing measures that should keep on supporting the short to medium term bonds. We have already seen some selling at the front end, though, so that becomes a very attractive point for entry. While the longer end, we might continue to face some pressure there because of the increased supply. So overall, from investors' standpoint, I think this is a very supportive environment for carry-oriented strategies. And investors can actually look at shorter funds like short-term funds or corporate bond funds kind of strategies if they have slightly longer, around 12-month plus kind of horizon. If your horizon is lower, it's better to stick to even lower duration. So low duration fund, ultra short term, those kind of categories. Yeah. So with that, I'll kind of stop here, and I'll hand over to Parag to talk you through the equity segment. So over to you, Parag. Thank you.
Thanks, Pankaj. That was very nicely explained. Hi, everyone. I will take you through the equity perspective on the budget. So when we look at the budget from the equity perspective, it is like a back to basics, no big bang announcement kind of project. It has followed a balanced approach, focusing on fiscal consolidation at the same time reviving your infrastructure growth capex growth, and also doing something on the consumption side as well. So focusing on the consumption as well. When we look at the major three areas where the budget has focused on, the first is, as I said, re-energizing your investment-led growth. Government has focused on capex again. And when we look at the capex side item, even individually, railways, road, and defense, all of them are now growing faster. Defense at almost 18% is much higher than our expectations, and also roads and rails at 8% and 10% are much higher as compared to the last year. So when we look at last year, FY26 RE number, which is only at 4%, from there, next year's almost 11.5% kind of growth looks much better. And that's how we are believing that government is again taking the path of investment-led growth. The second area where government has focused is building the indigenous manufacturing, supporting domestic manufacturing. And here there are many small things which they have done. They are focused on EMS, they are focused on PLI for autos, textiles, different manufacturing clusters. They have given support to rare earth corridors, critical minerals, chemical parks, and all these small measures are combining together to build a strong ecosystem for indigenous manufacturing. And thirdly, after last year's big push on the consumption through income tax rate cut, as well as in the middle of the year GST rate cuts, there's a strong consumption push which is already going on. But even after that, there are small things where government has focused on consumption this budget as well, through the rural income support via GRAMji and Manrega. Also focus on some of the other services like healthcare, on the travel and tourism. So that is supporting your consumption as well as services. So with these three different areas, we think government is focusing on a longer term picture. They are not trying to tweak something in only in the near term, but the focus is on the longer term, and that should help the industry, the country, for a longer time coming ahead. Moving on to individual sectors, how they are benefiting. So firstly, on the infrastructure, as I said, the capex is now again reaccelerating as compared to last year's only 4%. Now, basically, you are looking at a much higher growth. The capex to GDP remains stable at around 3.1%, but when we include IEBR into that, which is the support to states, that number looks at 4.4% as compared to 4% last year. Individually also, as I mentioned, defense, railways, roads, everything are looking much better. In railways, specifically, again, those 7 new high-speed corridors as well as new freight corridor announcement also bodes well. The housing and urban infra, on the capex side, the growth number is only at 5.8%, but on the revenue expenditure side, there is a strong jump of 50%. So overall on that, urban and the housing infra side also, we think government is pushing ahead. With this housing infra push and also the PMAY allocation becoming higher, the outlays for water irrigation like Jal Jeevan scheme being higher, we believe your building material sector will also get a positive boost. On the real estate side, some specific announcement on data centers, tax holiday for data centers, as well as safe harbor changes which are beneficial for GCCs, which should incentivize foreign companies to set up offices in India, which should result into a better commercial real estate demand in India. The other sectors which are getting benefited are on the indigenous manufacturing side. So automobile, where again the PLI support was higher. So the PLI outlay has increased from 20.9 billion to 59.4 billion. Also the PM e-drive spend had risen to 15 billion rupees, which both basically bodes well. Higher road capex as well as higher defense and MHCV procurement will be better for the auto OEMs. Specific on the EV supply chain as well. So government for last couple of years budget is focusing on EV demand in India. So these rare earth corridors in different mineral rich states will result into a reliable domestic EV ecosystem. So these all both been good for automobile. The other major sector was EMS. Here also, the electronic component manufacturing system scheme 2.0. There the allocation has increased from 240 billion to 400 billion over next 5 years. The another scheme was India Semiconductor Mission 2.0, where in FY27 they have announced rupees 10 billion outlay. Both these bode well for EMS companies. The consumer durables and the manufacturing in India should go stronger going ahead. The PLI for the large scale electronics looks slightly lower this year, but we believe that is mainly because of the completion of the PLI 1.0 for mobile phone assembly, and government will come out with PLI 2.0, maybe not this year, next year, but because of that we are seeing a slight reduction. But yeah, we expect when the PLI 2.0 comes back, we will see a higher allocation there as well. The third major announcement was on travel and tourism. There the government has come up with a host of announcements. They are trying to have better manpower, so they are trying to have National Institute of Hospitality, which will result into better manpower base with higher skills. They have pushed for developing destinations like archaeological sites, hikes and trails. They also talked about a Buddha circuit where they are trying to develop 5 destinations. There was also a TCS rationalization for international travel. So these all things should result into better travel and tourism, and the demand there should go up. The one negative point in the budget was mainly on the BFS side, specifically the STT on derivatives being hiked. So future STT is raised to 5 bips from earlier 2 bips, and the STT on option premium is now increased to 0.15%. This will result into a higher trading cost, especially on the future side. The impact on the option premium is not that high. It will be more on the futures side. That also more pronounced on the index futures rather than stock futures. But we also believe that although this will be impacting your exchanges as well as your brokerages, because the trading activity can go down, the volumes can go down. But as I said, the major impact would be on the index futures, which is a small segment as compared to the overall. So we believe the impact will still be restricted. AMCs, because they will pass on just this cost, shouldn't be affected because of this change. The other impact, as Pankaj also mentioned, we believe higher government borrowing may result in higher yields, and that basically might increase the near-term funding cost for banks as well as NBFCs, especially maybe the PSBs. But along with those negatives, there are some positives as well. So there is a banking sector review committee plan, which should result into a PSU bank consolidation, which should be a positive for overall system. Also, there is a targeted support for MSMEs, textiles, as I say, indigenous manufacturing, which should bode well again for the banking sector in terms of higher credit growth. Some other small announcements on the healthcare. So there is an announcement of the Biopharma Shakti, which is focusing on biologics, biosimilar ecosystem. There is also a focus on cancer and rare disease support. So there was exemption for 17 oncology drugs, as well as 7 more rare diseases related drugs were now included on duty-free imports. And also, government announced on medical value tourism. So they are trying to set up 5 regional medical hubs, which should again help the hospitals and diagnostic players as well. On the AgChem side, government is again pushed for many benefits for the farmers through push towards high value crops, fisheries, and animal husbandry, which again basically results into a better rural income, which should help consumption. 3 chemical parks are being announced to be set up, which should help on the chemical manufacturing side. So those were the good things on the AgChem. Other, as I said, small benefits, logistics. There is a launch of coastal cargo promotion scheme. There is a container manufacturing scheme with almost 100 billion outlay for the next 5 years. The rare earth corridors and basic custom duty exemption on some of the critical mineral mining value chain, those are benefiting the metals as well. Uh, the other main sector was on the consumption, but here, as I said, the major push was last year and in the middle because of with the GST rate cuts. So in this this budget itself, there are not many things. The major change was on the rural support of 45% through new GRAMG scheme, and along with Manrega, the combined allocation is up by 45%. On the tobacco side, there was some expectation that NCCD rollback might happen, but that hasn't happened. So that is slight negative. So overall neutral on the consumption side. There were announcements for textiles. So PM Mitra outlay was up significantly. Even the PLI allocation was higher. So that should bode well for the textile sector. These other sectors are not major announcement. IT sector, the buyback tax changes should benefit them in a slight way. So for last 1.5 years, we saw slightly less number of buybacks, which should again going ahead come back strong for the IT companies which have, large cash balances. Oil and gas sector qualities remain stable, not major changes, and the announcement were as expected. So there is no change in the retail fuel excise for oil and gas sector. And in the power utility sector also, we saw some zero import duty on nuclear energy side. So those were some other push. But as I said, the major focus for the budget was on the fiscal consolidation and at the same time reviving capex momentum and strengthening domestic manufacturing and infrastructure. No short-term tweaks, a focus on long-term. So it is laying the foundation for durable multi-year expansion across core and sunrise sectors. Thank you. Over to you, Sonal.
Thank you, Parag and Pankaj. I would like to open up the discussion with a couple of questions for both of you. With budget measures, in your view, will have the most meaningful impact on medium-term growth? Pankaj, you may start, maybe.
Yeah. So over the last 2 years, we have seen some change in strategy. So earlier it was more very heavy infra focus. They started reducing and built up some consumption expenditure as well since last year. But yeah, overall, I think there's been some focus on job creation. Those areas they are kind of addressing since last year. The overall expenditure has been kept under tight leash. So government has kind of, they in this budget, if you see, they are moving from doing themselves to facilitating. So if you hear the commentary, there were a lot of these words where they are going to review a lot of processes and trying to ease things for private sector through those things or enabling various things. So I think government is kind of withdrawing from doing more in the GDP than kind of facilitating for the private sector. But overall path, if you see, given the reduction in taxes, both from the direct side and the indirect side, the reduction in tax rates, that should be supportive for the economy overall. And also the deregulation push that government is doing since last year, that should also be supported. So yes, from a medium-term perspective, these signs are encouraging and it seems to push or keep the growth rate at these levels at least.
Thank you, Pankaj. Parag, your views over here?
So the way I look at it, government is maintaining a consistent stance on focusing on indigenous manufacturing, Also, now this year they are focusing on capex led growth. Last year was a focus on consumption. So they are not leaving any areas untouched. They are making sure not in a single year, but across 2, 3 years, all the different areas of the economy are getting supported by the government. They are also making sure that states also participate more. So this year we have seen the proportion of states is going higher in the capex. So that way, I mean, even if they are little tied up because of the fiscal consolidation, they are making sure that small things which can be done, those are being done properly, consistently, which again, as I said, maybe nothing is as a big announcement, mega announcement in this budget, but the building blocks are being put in place, which should help, near to longer term growth.
Sure. Thank you, Pankaj and Parag. Were there any surprises or areas where expectations were not fully met?
Um, as a whole, I didn't find anything where I can say that it's a big surprise. But as I mentioned in my presentation, one thing that on the deficit reduction part,
Mhm.
so if you have to move from 56% debt to GDP to 50% in 5 years, we would expect slightly higher reduction every year. And to that extent, I think it was a bit of a setback where government put it at 55.6 only 50, half a percentage point reduction. So hopefully in the next few years, we'll see a faster consolidation and they will go to those levels what they had proposed last year. Apart from that, I don't see any big surprise on anything.
Parag, you would like to add?
So, in some circles, we were hearing about maybe some more tax cuts, maybe some benefit on the capital gains taxes. But if you ask me, frankly, I mean, the way they have gone last year with the consumption boost in the middle of the year, as I said, the GST tax cuts, uh, the leeway in this year was actually less. And that way, I wouldn't actually call that no major announcement on those sides as anything which was unexpected completely.
Right.
So I wouldn't call that unexpected. I believe that is how it could have been done. They have, again, as I said, focused on some areas to boost the consumption, mainly on the rural spending, that 45% increase on the rural spending. In terms of capex boost, yeah, it was slightly higher. Again, as compared to last year, it looks high. So maybe you can mention it as a surprise. But again, I don't want to call it as surprise. As I said, government is trying to touch on all the areas. So last year it was consumption. So this year it is actually kind of expected that government will try to push the capex ahead. Last couple of years, actually, the capex was slightly on the lower side. So from that background, we were actually expecting the capex can go up. The numbers look actually really good. Defense at 18%, railway road at 10% are actually really good. That should actually then kickstart the overall capex at the state levels, at the state center level, the state level, and even maybe the private capex then should restart again in the country. So that's how I am looking at it.
I will now move on to the audience questions, and in fact, my one of the question is on consumption. So, Parag, I'll begin with you there. With no major changes to personal taxation, does the budget still meaningfully support consumption demand, or will growth remain investment led rather than consumption led?
Yeah, so now, as I said, I completely agree that no specific announcement in the budget. But yes, last year's impact of the consumption boost will still has to play out specifically on the GST rate cuts. And along with that, they have focused on the rural income. So the GRAMG plus Manrega allotment going up by 45%. The focus on the agrochemical side, the schemes there. Also, the focus on travel and tourism related services. So those are the areas where government has focused on consumption. So although the overall focus on this budget seems like that they're trying to revive the capex, I wouldn't say that the consumption was completely ignored. They are saying that whatever we have done in the last year, let that play out, and also some of the other areas they have focused on. They have also done some other things on the healthcare side as well. Right? So consumption through these services, they are also trying to boost them. So I would call that going ahead, it is hands in hand with both consumption as well as the capex led growth. It's not, they are not trying to drive the economy only with consumption or only with capex. It's more of a balanced approach now with this budget.
Sure. Pankaj, my next question is for you. How does the budget's fiscal deficit target and glide path affect the sustainability of India's growth story? Are we likely to see a stronger private capex response?
Yeah. So on the first part, one that in the last 5 years, we have seen a much faster fiscal consolidation, and yet our growth held up. And going forward, and in this year especially, we have seen a slower and probably will continue to see a slower fiscal consolidation, more gradual way of consolidating and reducing their debt. That should continue. So overall, I think it won't affect the growth impulse in a big way, where they have freed up some of the or reduced the tax burden overall. So that should be more supportive than the fiscal consolidation or the spending of the government. So net, I think the fiscal consolidation will not affect growth in any big way. On the macro stability point of view, this will be a great move. So over a medium to long term perspective, the fiscal consolidation should be supportive for growth. On the private capex side, I think it's a puzzle which everybody is trying to solve for last many years. Despite all the spending big boom from the government side, we have not seen that kind of pickup. Though household capex did pick up, especially through real estate activity, and hopefully that will sustain. Given we have seen some relaxation on the tax part, which impacts of which will be more long lasting. So we have seen some saving for households through the income tax reduction and lately through the GST reduction. So when you get those savings, that also affect your overall asset building framework. So even from the household, I think we have a better clarity, but on the corporate side, that should actually helpful if consumption also increases and we see some pickup in demand. That should be helpful. The overall global environment, that is little tricky and that remains negative. So it's difficult to take any clear call. Maybe Parag can help there more. But from my side, I think domestic environment looks better, but global environment looks slightly complicated for private capex.
Okay. So Parag, do you want to add something to it, or we move to the next question?
So overall, the growth side, as I said, some of these areas where government is specifically focusing on, so EMS, the component manufacturing, the PLI for auto, even maybe in textile, and in general, the capex push this year. So as Pankaj said, we were waiting and still waiting for the private capex to go up. Maybe this push by the government, if, as I said, the central capex goes up, if that has a cascading impact on the state as well as the private capex, then it will actually be a lot more beneficial. But we'll have to wait. As I said, some of those specific sectors where government has, as I said, EMS, the auto, textile, there those benefits which government has announced. With that, if that capex starts, and maybe then it has a cascading effect on other sectors as well. So we'll have to see. But as of now, only those couple of sectors where we think there can be some more focus, some more a push which can happen, and we'll have to slowly see how that overall pans out.
Sure. Parag, I would like to take this question with you. Are there any specific sectors where budget allocations could translate into earnings visibility? Maybe this is a continuation of the previous question rather than just sentiment. So, how quickly can this flow into the corporate balance sheets?
Again, as I said, in the budget, there are no near-term tweaks, right?
Correct.
It's more of laying building blocks for the long term.
Mm.
So, in that sense, then the specific capex push. So yes, the defense companies should definitely benefit with this much higher demand for them. Even the rail and road capex going up. So those companies should benefit in the near term immediately. Also, the new PLI schemes or the higher allocation towards PLI schemes. So your EMS companies, maybe some of the consumer durables as well. So those companies might see some benefits. The other was on those rare earth corridors. So in the auto also, your EVs or on the mining companies, those rare earth corridors get set up. But as I said, some of these things are not happening immediately. Some of those benefits we'll see accruing over next 2-3 years, maybe slightly longer as well. So on the immediate impact, maybe it is mostly that capex push on the defense, road, railway, and maybe on the higher rural income side, that directly translates into consumption. So that would kind of benefit some of it. But other than that, as I said, it is a slow, gradual, but more sustainable kind of benefit which will drive the economy over longer term.
Sure. Thanks, Parag. Pankaj, my next question is for you. What are the likely implications for the CPI release no, on 12th of February and GDP data on 27th Feb following the change in the base year?
Yeah. So one that as data suggests that weight of non-food inflation will probably go up, and while the food inflation weight will go down. So one clear thing where we have greater confidence is probably the volatility of inflation will go down, because food prices have been quite volatile, and that add to a lot of volatility in the headline inflation number. Secondly, if you look at the overall trend, how inflation is shaping up, though in the current series, core inflation looks higher. Much of that is contributed by prices of golds and silver. If you just look past them and look at the overall trend of inflation in household goods and services, that has been quite benign. And given the surplus capacity overall, and the way the US has imposed a lot of tariffs on various countries, I would expect more goods from the surplus producers to flow into different countries, including in India. So we are already hearing about Chinese dumping in various parts of the world, and that will keep prices low for all the goods and services. So broadly, I think I won't expect any significant change, but volatility will go down. Overall inflation should remain benign, because even the core goods and services inflation will remain really manageable, given overall disinflationary trend in the globe apart from US, I would say. So yeah, so that's how I'll expect it to shape up. But for the this year, inflation was much lower than their usual trend. There was a one-time impact from tax cuts. The food prices also normalized. Food prices were, especially vegetables, were very high in the last 2 3 years because of unseasonal weather patterns, and that kind of corrected in this year. So for the next year, there will be some base effect that will play out. These things will normalize in the headline numbers. So from very low inflation this year, probably we will get back to the closer to 4% reading in CPI next year, but not much change from there. Yeah. On
Sure.
the GDP means I have to still review those things,
Yeah.
how that's going to affect, and probably that will take more time to see the impact.
Sure. So, in the interest of time, I will just take two more questions. Parag, this is one question which is most sought. How will the increase in STT impact funds that use derivatives as part of their investment strategies?
So, as I said, mainly this will be on the arbitrage fund side. So the cost going up will definitely have some impact. Uh, so actually, but again, this is more for those where the high frequency traders or the global funds where the volumes are at a significantly higher quantum. Those will be impacted much more because of this. Uh, and actually, with the AMCs, again, this basically gets passed on. So yeah, I mean, directly the AMC won't get impacted, but yes, those funds basically the cost will go up slightly. As I said again, the major impact is on the futures. On the options, impact is kind of limited. The actual cost going up for option premium is not material. But yeah, for the futures, the cost is going up substantially. But even again there, it is going up more for the index futures rather than stock futures. So the funds where the proportion is more on the stock future side, there also the impact would be less. So yeah, funds, like as I said, arbitrage funds, where basically some kind of index futures are being taken to manage the positions, we'll see slight impact. But internally, I mean, we haven't exactly finalized because it will depend on how much is the position, how much is the proportion of those futures. But internally, we are also not looking at material very high impact, maybe few basis points here and there, but nothing very material is what the initial assessment is.
Sure. Thanks, Parag. This one question I would like know feedback from both of you. How should investors think about positioning portfolios in the light of this budget?
So on the fixed income side, as I said, the overall fiscal consolidation is healthy thing, and this should be helpful for the bond market over medium term. But in the immediate future, what we see is that there will be some supply pressure from bonds, given they have pegged the fiscal deficit slightly higher than expectation, and also the borrowing number slightly higher than expectation. So maybe investors should look at more at the front end accrual kind of strategies at the shorter maturity segments. So if you have a slightly longer horizon, more than 12 months, short duration corporate bond fund kind of strategies, or even for 2 year horizon, if you're looking at the FOF, arbitrage plus income fund, those kind of strategy where you can gain even that on the tax side, the net of tax return will be much better for investors. So those kind of strategies are kind of more helpful in this kind of environment where we have pressure at the longer end.
Parag, your views?
From the equity perspective, as I said, the budget is actually impacting or basically benefiting all the areas of economy, right? So there are no specific sectors which are getting benefited. All the sectors in different measures are actually will benefit from this budget and what are the other steps that government is taking. So in terms of portfolio reallocation, I wouldn't suggest say moving from one sector to anything else. I believe that all the sectors will be benefiting from this budget. The main point would be the budget is focusing on medium to longer term growth, the support for our laying building blocks to have that strong growth in the medium to longer term, which basically is instrumental for equity investment, right? With that longer term horizon, we believe what budget is telling investors is stay invested for the longer term. We are also focusing on that long term wealth creation. Stay invested for that longer term, and you will also participate in that wealth creation journey.
With that, thank you, Pankaj and Parag, for sharing your valuable insights. And thanks to all our participants for joining us today. To briefly summarize, the budget reinforces a long term growth oriented approach with continued focus on infrastructure and manufacturing, a steady path for fiscal consolidation, and selective financial sector reforms. Together, these measures create a supportive backdrop for sustainable economic expansion and investment opportunities. We hope today's discussion has helped you better understand the key takeaways and how to interpret them from an investor's perspective. Thank you once again and have a great day ahead.
Thank
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.